For everyone who joins us, this is going to be probably take about an hour to go through everything. This is a home buying seminar that we're doing virtually. My name is James Bowerman. I'm a realtor at the Real Creative Group of Douglas Realty, and today I have Armin Minokian. If Armin, you want to introduce yourself?
My name is Armin Minokian. I work with Coastline Mortgage, and like James said, we'll be going over a first-time homebuyer seminar today.
Perfect. So I will share my screen and we'll jump right into this. You see that, Armin?
Yes, I can.
Perfect. All right, so we even got the little actions here. So this is our home buying seminar, get the facts on buying a home in today's market. And obviously we're doing this virtually because of what's going on in the world. As we said, here's who we are. So welcome and thank you for joining us. If you're watching the replay, thank you. This is live and going to be engaging. So as people hop on, I'll try to monitor comments, answer any specific questions you have. But we're going to get started. And I always like to start with why buy versus rent, because there's a lot of people who, are renting and maybe are considering buying or think they should continue renting. To start with, buying a home is an investment, and it's a great investment over time. It's proven that it's an asset that will, it will appreciate in value. So when you're renting, you're paying off somebody else's investment. They're paying down their mortgage and having that physical asset that they can then liquidate and sell later on, or leverage to finance other deals and things like that. So buying a home is a great investment if you're going to hold it for time, as opposed to just throwing your money away month to month on rent. As I mentioned, you create equity. So the home is going to be worth a certain amount, and if you have a loan on the property, it's going to be less typically than what that property is worth. And at a certain time, you can actually tap into that equity and use that for, say, home equity lines of credit, things like that. You have the freedom to renovate, so you can do whatever you want to your property. If you're currently renting, they may have restrictions on what you can do as far as, painting or knocking down walls, things like that. You can completely do whatever you want when you own the home. And you also get a sense of pride, sense of ownership, makes you feel good. It's the pinnacle of the American dream, right? It also helps with credit when you have a home that you own versus renting. And there are tax benefits too, so that at the end of the year, you get to claim certain things like depreciation and your mortgage interest, things like that. So you're actually getting money back on your taxes. So I like to break this down into 5 steps, and we'll kind of touch on a couple of the things that have changed due to what's going on with the COVID-19 quarantine, stay-at-home orders, and everything that's happening. There's never been a time where properties have not been bought and sold. We're still seeing a lot of activity on the market as far as homes closing, homes going active for sale. The thing to keep in mind that we will see it slow, because the way real estate works, it flows through a pipeline where a lot of the homes closing today were actually put on the market 30 to 60 days ago. So we are seeing a slight slowdown in homes coming on the market, which we'll see an effect probably in another 30 to 60 days due to the quarantine. But the 5 steps, keep it pretty simple. The first one I always recommend is choose your realtor. So why do we want to choose a realtor? First, well, let's explain agency, because when you go to purchase a property, more than likely that property is going to be listed by a real estate agent, and that real estate agent has what's called a fiduciary responsibility to represent the seller. They don't represent you. They do not have your best interest. So when you choose a realtor, when you're buying, you leverage their experience, their knowledge, their skills to help you purchase a home and guide you through the process, negotiate on your behalf, and have your best interest. That is agency. And when you have a buyer's agent, you do not have to pay them anything, because their commission is coming from the seller. I might be jumping ahead here, but realtor versus real estate agent, there is a difference. A realtor basically is someone who has joined an association, National Association of Realtors. they're held to a higher level of ethics and standards versus just a real estate agent, someone who just went and got their real estate license. So when choosing a realtor, first and foremost, you want to find someone that you're comfortable with, because you're going to be working with this person for, again, probably 30 to 60 days. And then beyond that, sometimes it can take up to a year or more from the time you first have that conversation, depending on what you need to do to get ready, to save money, to get your credit and where it needs to be. But you're going to be spending a lot of time with this person and talking about some things that typically might not make you feel super comfortable diving into finances and different life events. So someone you're comfortable with is going to be important. Next thing is knowledge of the purchasing process. So it's tough for new realtors getting started because they haven't actually gone through a transaction, and a lot of what they learn in getting the real estate license doesn't typically apply to contract to close transactions. So working with someone who knows the process and can guide you through it to help avoid any sort of legalities or issues, or just be completely unaware of something that's going to cost you on the back end. So specializing in your geographic area. So I also recommend you work with someone who knows the area, who knows the cities or the communities that you want to be in, so that they can advise you on certain things and get you into a place that aligns with what your goals are. So through this graphic in here, buying a home during a global pandemic. So obviously with the stay-at-home order, and there's a lot of people who are just afraid, and for good reason. They don't want to bring in the virus to their home and potentially be exposed to it, and vice versa. You don't want to go into a home and be exposed. So actually, let me exit out of this real quick. I just want to show, can you still see my screen, Armin?
Yes, I can.
Okay, you can see the COVID-19 showing guidelines.
I see they're buying a home during a global pandemic currently.
All right, here, actually, let me switch here. How about now?
Yep, I can see it.
Okay, so this is something that I put together for my active listings, so that my sellers have a little bit more peace of mind, and we're making sure that we're doing our due diligence, as an industry, to make sure that we're trying to, keep in mind your health and your safety, as well as those of the sellers or the other party involved. So first and foremost, we want to make sure that all buyers are pre-qualified. So if you haven't gotten pre-qualified, and we'll touch on that very shortly, you don't want to be going out and looking at houses. If you're not pre-qualified, then unless you're buying the house cash, then you're not going to be able to buy the home, and it's just not something you want to do right away. Secondly, fever and symptom free. We don't want you going out and looking at homes if you're feeling sick, for obvious reasons. Decision makers. So we want to limit the amount of people who are actually going and looking at homes. And I should preface this that, real estate agents and all parties involved, title, lender, we have been named essential. As I said, there's never been a time where properties have not been bought and sold. So we are essential. There are lots of people who are, like I said, homes coming on the market, buyers going under contract. People need to move. They need to buy, they need to sell for whatever their reasons are, and they're motivated, and they have to go out and they have to do this. But we want to make sure that we limit who's going in the properties. We don't want you bringing your kids, your parents, things like that into the home. Try to limit the amount of exposure for everybody. Try to refrain from touching anything. Ideally, a lot of agents, I've always put up videos and virtual tours, but we want to try to look at those first and foremost, to maybe eliminate any options that we can by looking at the virtual tours and seeing it, driving by the home to make sure that the area is somewhere you want to be before we start going inside the home. Overlapping appointments, that's more on the real estate side, but we don't want multiple parties going in at the same time. Using hand sanitizer. As of today, we're all required to wear masks now when we're going out, and then practicing social distancing. So those are the kind of things that I'm putting on my listings, which I think are would be pretty good to share broadly. Let me jump back to my presentation here. All right, so Go through this again, covered that and what's going on. Ready, willing, and able, that's always been kind of the tagline that we're, as realtors, supposed to bring buyers to show a property. They must be ready, must be willing, and they must be able. And able is kind of a key word there when we talk about getting pre-qualified. Oh, I forgot I put this in here. So this kind of goes through everything I just touched on as far as being able to view properties. So step number 2 now, getting pre-qualified. Armin, I'm going to hand this off to you and let you go through it, and I'll just kind of push the button here.
Okay. So thank you, James, for the introduction. Like James was saying, the most important part of this process is also getting pre-approved for a loan. A lot of times people will start looking online, get an idea of what they like, and then they get pre-approved, and it might push their process back 3 to 6 months, depending on their credit or where they qualify. I always tell people, if you're thinking to buy in 3 months, 6 months, a year from now, it's always best to get qualified as soon as possible. By getting qualified as soon as possible, if there's certain things that we can take care of, so by the time you're ready to move, it's not a surprise and we're ahead of it. Getting pre-approved, like James said, you know how much your payment's going to be, you know how much you feel comfortable with, and you know what areas to look in. Being pre-approved versus pre-qualified. Being pre-approved, we verify your documentation, bank statements, W-2s, pay stubs, pool credit. Pre-qualified is basically just getting your credit checked and getting information from you and trusting that that lines up exactly. I always recommend people to get fully pre-approved just because it makes your qualification, makes your pre-approval letter stronger than just being a pre-qualification letter. Creating a plan, narrowing it down, finding out where you want to be in, and that's something James could help you in with, realizing what county you want to be in or what school district, narrowing it down to bedrooms, bathrooms. And from there, we create a plan on the financial side of, okay, how are you going to come up with your down payment? Do you already have it in savings? Does it need to come from a gift? Does it need to come out of your 401k? Do you need to explore a grant option? So that way we know exactly how to put in your offer on a property that you might find. Like I spoke about before, knowing your budget, that's huge, because let's say you find a $300,000 house in one county versus another county. Just by the purchase price doesn't mean the monthly payment is going to be the same, even if you put the same amount down. From one county to another, the taxes could be more, $1,000 to $2,000 more on the year. So in turn, your payment's going to come up, anywhere from $75 to $200. So something to keep in mind. Or also knowing your budget, if you're looking at single family homes and then all of a sudden you shift it to possibly a condo or a townhouse and the purchase price is around the same, keep in mind that they do have condo fees and they do have HOA fees as well.
And one more thing I want to add on that is we use this term being house poor, and I'm sure you find this often. Somebody might be pre-qualified, say for $400,000, right? But what does that monthly payment look like? And they're like, whoa, that's I don't want to pay that much. So really figuring out what that comfortable monthly payment is going to be versus what you're approved for.
Yep.
Oh, and here we go. Saving for down payment. I think we covered all that. All right, so what do lenders look for?
So main thing is debt to income ratio. Once we pull credit, we will see all your current debts that show in your credit report. And once we get your income documents or get your income from you, we can tell exactly how much you'll be able to qualify for. Credit score is a big factor, especially with the recent changes to guidelines due to COVID. The credit score restrictions are becoming tighter and tighter versus before. They were not as tight against borrowers. Cash and assets. Assets typically have to be in a bank account, 401k, or a gift. Typically cash, they call it mattress money. We like to avoid that kind of situation. So if this is a situation where you do have cash at home, it's always best to be upfront and honest with your loan officer in the beginning. So that way it's a smooth process and there's no surprises along the way. And sorry, just keeping up with the slideshow.
Yeah,
Some of
no,
the
I'm
stuff that
sorry.
you,
It's tough when I'm pulling the trigger over here and
yeah,
can't see what's
some of
there.
the stuff that you will need for the pre-approval process would be 2 years of tax documents, whether you get paid on a W-2 or a 1099. Most of the time, if you get any type of commission or if you are on a 1099, we will need tax returns as well as W-2s. Most recent pay stubs, about a month of pay stubs. So if you get paid weekly, obviously we'll need at least four. Social security card, IDs are some of the other items we will need, as well as bank statements or any type of assets that you're using to source your down payment. We have to source any type of down payment and make sure everything lines up with what you're telling us.
Gotcha. I'm just going in now. I want to see
Assets
if
that you're using to source your down payment. We have.
all right. I just want to check real quick. I wasn't really looking at the comments, so I was doing this. Couple questions. Will the seminar be recorded? Yes, it will. Okay, you already answered that. What if you have a cosigner? So I don't know if you want to talk about the cosigner at this point.
Co-signer, sorry, I didn't see that question. Co-signer is definitely an important question. Depending on the co-signer, whether they'll be living with you or a non-occupying co-signer, it makes a difference. So that's something I would consult with your loan officer to get more information on, because each situation can vary. So if you go with a broad statement, it could differ to your particular situation.
Perfect. All right. So breaking down the mortgage payment as we kind of discussed, and one thing I actually talked to somebody today, they said, oh, I was looking at Truly or Zillow or whatever, and it showed me what the estimated monthly mortgage payment was. And I said, well, keep in mind that when they're showing you that number, it's probably assuming that you have a great credit score, a great rate. You're putting 20% down, and it's not going to include the property taxes or the homeowner's insurance. So typically it's showing a really low number to get you to say, oh, okay, get engaged, because a lot of those platforms are for advertising. And every time you click, somebody gets paid. And so just, Armin, you want to break this down for everybody and kind of explain that, it's one of the biggest misconceptions that I have to put 20% down and how all this
Yeah.
works. So please enlighten me.
Absolutely. So this example here is with 20% down. The payment shows a total of $1,368. For this breakdown, I would say this would be more towards Anne Arundel County, Baltimore County. When you get into PG County, Montgomery County, those property taxes might be closer to $300, $320 a month. So that's something to also consider. Like James said, that is a huge misconception that you have to put 20% down. There are some grant options out there, but like I said earlier, with the current situation with COVID, a lot of these grant programs with the guidelines, they are changing rapidly. So if you were qualified with one, check with your loan officer to make sure you still are. On that note as well, if you are a first-time home buyer, or in general, if you qualify for a specific program, you can put as little as 3% down. And with 3% down, this payment would be very similar, but obviously the principal and interest would be higher and the mortgage insurance would be higher. So in the same situation with only 3% down, you're looking at about a $200 increase from this payment. So just under $1,600 per se, if you were only putting 3% down. There are other options as well in certain areas. There's not too much in Anne Arundel County to get a USDA loan, but USDA loans is a 0% down loan. So if you want to live somewhere in Carroll County, they're pretty common out there. We also have VA loans. If you are a veteran, that's a 0% down loan. Now, that doesn't mean when it's 0% down or it's just your down payment, keep in mind that there are closing costs still involved. Typically on a purchase, it's anywhere between 3 to 5% in closing costs help. So if you were not to get them covered by the seller, that's an additional cost that has to come from you. There are other ways that we could try to, potentially give you a lender credit to cover a portion of it, but that would also affect the rate. Trying to think what else. There's also FHA, here we go. Conventional VA, FHA, construction rehab, USDA, and hard money. All these are credit reliant, and also if you're not a veteran, obviously you can't get a VA loan. USDA, like I mentioned earlier, is specific to certain areas. Hard money is something that you would use if you're interested to flip a house or to hold a house short term, or if you're in a situation where you can't qualify for a traditional loan, potentially you would use something like that and then at a later date refinance. But like I mentioned earlier, before you plan to do something like that, check with the loan officer because guidelines are changing in the current environment that we're in.
All right, so this is something that Armin, you put together, kind of breaking down some of the different loan types, the most common ones, FHA, conventional, VA, what that down payment looks like versus your monthly payment for a given range. This is a pretty comfortable range, and Anne Arundel County for a first-time home buyer. You want to jump into any of these specifically?
Hold on. Yes, I can. So, like James was saying, the down payment on FHA, it's typically 3.5% down out of pocket. And on this particular chart, I only use 3% down for conventional. Now, if you are not a first-time home buyer and you don't qualify for certain programs due to income, if your income is over the limit for that county, then you would have to be required to put 5% down going conventional. And that, like I said, that's something that we could go into further detail, or if you contact your loan officer, they'll be able to go into further detail regarding that. And like it shows here, VA is 0% down, so you can see the difference in the payments. FHA typically has slightly higher mortgage insurance, and conventional, the mortgage insurance is credit reliant. So the better your credit is, the lower the mortgage insurance will be monthly.
Got it. All right. So down payment and closing cost assistance. Let's talk, that obviously things have been changing. They're getting a little tighter on some of the things going on now. Do you want to touch on any of these things that are available?
So kind of what we touched on these a little bit earlier as well. First-time home buyer, there are some first-time home buyer grants and programs, but like I said, the guidelines are changing rapidly. There's always stuff out there that you can utilize, but a lot of them are credit reliant. So family, if you do get a gift from family, depending on the loan type, always consult with your loan officer before. I've had situations where somebody's father took out $3,000 in cash and gave it to his daughter, and she deposited it in her bank account. We ended up getting it done, but if he just wrote a simple check, it would have made the process a lot easier. So before you do anything like that, if someone is helping you with a gift, and it's not coming directly from your bank account, just like I said, consult a loan officer and they'll walk you through the easiest way to get it done.
Yeah. All right. So that wraps up step number 2, which great points, all, leading into why you need to take this step before we get to step number 3, because, even that last one about a family member giving you cash, now you have to season that, and it's going to hinder you from being able to move forward. So always good to have that conversation first and come up with that plan, that strategy, where the money's coming from before we start looking at houses, so we don't do anything to hinder our ability to move forward. It's still a pretty hot market, to be honest, and homes are still selling very quickly. So, where we were and where we are and where we might be, it's hard to say, but, the fact has been for the last several years, we're in a seller's market, and these homes do sell quick. They're selling with multiple offers. So if you're not ready to pull the trigger and put in an offer and compete, then you're just going to lose it, and then you're going to get disheartened. So always good. Real quick, Armin, the process for getting pre-approved, how does somebody typically go about that, and about how long would that process take?
So typically it doesn't take too long as you do cooperate with the loan officer. If it is me, when I start a pre-approval process, I usually take the initial phone call, introduce myself, get an idea of where the client or you potentially would be at. And from there, I typically have the client fill out my online application, and with their permission, I will check credit. Once I view credit, I'll let them know where they qualify, and as long as they send the supporting documents that I need, like we mentioned earlier, 2 years of tax documents, pay stubs, bank statements, ID, social security card, items like that, then I'll be able to issue a pre-approval letter versus a pre-qualification letter. And a pre-approval letter is stronger than a pre-qualification letter when it comes time to making an offer. So that goes back into strategizing and making sure your plan is in place, because you don't want to, like James said, put an offer in on a house and then be scrambling to try to get it done. And now you lost the window of now you are out of the window of opportunity because we weren't fully prepared.
All right. Thank you, Armin. So let's jump into step number 3 now, everyone's favorite part, which they like to try to do first. But, you know, step 1, find that realtor. Find someone you like. They're going to be to help you out a lot. They're going to be able to put you in touch with quality people, especially step 2, which is finding that lender, getting pre-approved. But now that we have that, especially in today's environment, you know, you're pre-approved, everyone's feeling well, we know what to do as far as showing homes. We're going to define your location. We're going to come up with where are the areas you want to live, what are the style and the type of home. Do you want a single family that's detached? Are you okay with a townhouse, maybe a townhouse and unit? Do you want a rancher? Do you want a split foyer? All these types of homes, these physical features, beds and baths, square footage, all these things that you need or that you want, we're going to break that down and be able to send you basically through email is typically the typical process coming from the MLS, which is going to be the most accurate with the up-to-date listings that are active. Some of these other sites, they keep listings that are already under contract. I get a lot of calls about properties that are already under contract that aren't available to tour. So really working with the realtor, they're going to be able to give you the most updated information and be able to pull any kind of details of if it's bank owned, it's a short sale, all those things to make sure that we're looking at, you know, the properties that are going to be a good fit for you, as well as coming soon listings, which if you've seen any of my market updates, I always talk about coming soon listings. Again, in today's market where it's a seller's market, a lot of real estate agents are taking advantage of coming soon, which is a status in the MLS. You have active, you have under contract, but coming soon, you can have a property up to 21 days listed, not visible to the public. It's not going to show up on Zillow. It's not going to show up on Trulia, or it's only going to show up on the MLS. But we can send our clients those properties, and that's what gives you kind of a first mover advantage to see what's going to be coming on and be able to act and respond quickly in today's market. Before you go, we want to make a list of homes that you want to see. We want to make sure that we're, you know, if possible, we want to, especially, you know, trying to maximize the efficiency of our time spent going out and looking at homes. So make a list of homes that we want to see. That way we can schedule those and get those coordinated. We want to view the video walkthroughs and drive by the home if possible beforehand, like I mentioned, to make sure that we're eliminating any options that just aren't going to be a good fit. We're going to take advantage of those virtual open houses. Normally this would say open houses, but a lot of agents basically have shut down, stopped doing open houses altogether, but we're seeing more virtual open houses. The reason why I have buyer beware is because the agent holding the open house works for the seller. So you might go there, and of course they're going to be very friendly and they're going to give you, you know, information that you ask, but they always have the best interest of the seller, and they're not going to divulge anything or do anything to really necessarily benefit you. They'll be happy to help you purchase the home, but again, they always represent the seller. So be cautious with bank-owned homes. A lot of different nuances with the bank-owned homes as far as requirements. I know sometimes I see a lot of buyers looking at these because it seems like a good deal, but most of the time they need a lot of work. Typical loan products aren't going to be accepted on those. You might need cash. You might need to do a rehab loan. You just need to understand the nuances of those. If it's a short sale, which means it's going to go into foreclosure if they can't sell it, it typically takes at least 90 days to close on. So if you have to be into a home quickly, it's probably not a good option for you either. So just working with your agent to understand what the nuances are of each one of those properties. So step number 4 is making an offer. This is the critical point of, you know, what do we want to do to get into this home? It's definitely been a challenge in this market to make a compelling offer, not really knowing how many other offers are coming in. A lot of times we'll present an offer and then we get another email back, says, hey, we got multiple offers, make your best and highest, kind of conditioning us to say, well, let's not, lowball them. Don't see a lot of lowball offers in this market. But let's talk about the different pieces of that. The offer itself becomes the contract. So we have the specific forms that we use to put this offer together. Once that's signed by all parties, that becomes the contract. So it's essentially one and the same. Things we can do to help protect during COVID: electronic signatures. So we can do a lot of things digitally now. Electronic signatures is one of those. I use DocuSign, but be able to send you forms to sign without leaving, the comfort of your home. Purchase price. So purchase price is the big one as far as what the seller is going to look at, what's important to them. More often than not, they're looking to make as much money as they can. Sometimes they're motivated by time as well. How soon can they get out of the house, or if they need to stay in the house. So the purchase price is the dollar amount that you want to pay for the house. Seller concession, also referred to as closing help for the buyer. We're basically asking the seller to take some of their profits and give that to us to apply towards closing costs. So that's typically, we're seeing that happen. Anywhere from 0 to 3% is pretty typical in this market, even though it is a seller's market. Understanding, especially for first-time buyers, that it's just difficult to save up that much money and get into a home. So if you're thinking, oh man, I gotta do my down payment and then I've got 3 or 4% of closing costs to save up for too, just understand, talk to your agent. It is possible to get some of this money from the sellers to pay those closing costs and make things happen for you, and talk about structuring that as well. So that's seller concessions. Earnest money deposit, the rule of thumb is 1%. I've done less, I've done more. This is really your money that you put into an escrow account. It's going to be held until the end of the transaction and applied towards your closing costs. 99% of the time, you're going to get that back. If, say, we go through the inspections and you found something that you don't like and you want to get out of the contract, you get your deposit back. Most of the time, you're going to get that back. Only if you get to close to the very end and you do something to violate the agreement, then the seller is probably going to be upset. They're going to want to take that because you cost them time and you cost them money. They're going to have to relist the home. Loan type and down payment. So we talked about the different down payments associated with these different loans. Some loans are looked upon more favorable than others if you have competing offers. For example, a conventional loan versus an FHA loan, they're not necessarily apples to apples. So if we have two similar loan products, or there's two similar offers, one has conventional, one has FHA, typically we're going to lean towards conventional because there's going to be less restrictions, and we know that the buyer is a little more qualified. So just understanding those types of things when you're competing as to make a stronger offer. Repairs, credits, warranties, and inclusions. These are all contingencies, basically. When we put the offer together, are we going to do an inspection? Most of the time we are. There's times where we can buy the property as is with the right to terminate, which means we can do an inspection, and if we find something, we can get out of the contract, but it's assumed we're not going to ask for repairs. The repairs are something that's going to cost the seller money. It's going to cost them time. They're going to have to talk to contractors. The credits as well. So if we're asking for money in lieu of repairs, or if we're asking for more towards closing, home warranties, that costs the seller money as well. And then any inclusions, if you want to include, certain, like the refrigerator or the riding lawnmower, things like that, they all have a monetary or a time value to the seller that they have to basically put together. So the cleaner the offer, the more compelling, the more easier you make it for them, the more money, and adhering to their timeline is going to be more of a compelling offer that is more likely to get accepted. I do want to add one thing that I believe just as this year, we used to in the past include letters from the buyers, sometimes including family photos. It used to be a really good strategy that we could use, Say, hey, we really love your home or a family. We're not allowed to do that anymore because it violates the fair housing laws. So just keep that in mind. That's not something we're typically going to include anymore. And then settlement date, like I said, talking about the timeline, what is going to be the best option for the seller if they're looking to move quickly, and we can move up our settlement date, or if they need to stay in the home and we're flexible, for renting, maybe we can rent for another 30 days, go month to month. That might be more compelling, even if it's a less, uh, not as high as an offer or purchase price, but we can fit their timeline. It might be more compelling and more reason for them to accept it as well. So on that note, Armin, do you want to touch on the right side here of the closing concession maxes allowed for these different loan products?
Yes. So VA, you can technically go up to 6%, but you typically won't need more than 4%. For USDA and FHA, you can get up to 6%, and then for conventional, it gets a little funky. After 10%, you can get 4%, and then after you put 20% down, you can actually get 6%. So for conventional, most closing costs are going to be about 3.5%, give or take. I would say on a purchase over 225,000. The lower purchases, let's say if you get a purchase in Baltimore City for around 150,000, the closing cost might be closer to 6% versus 3% on the typical norm. Or let's say if you found a house in Anne Arundel County for 250,000 versus PG County for 250,000, the closing cost might be about 0.5% more because of transfer taxes and the prepays for the monthly taxes that are collected.
Got it. Awesome. All right. Let's step into the next part, negotiating. So now we submitted our offer. We made a fair offer. We looked at comps. We didn't just go off of a feeling, because everyone has the ability to do their own research, their due diligence. Most people aren't just arbitrarily picking a number. However, we are going to look at comps and determine what a fair offer is based on the other homes that have sold that are similar and nearby. Sellers typically are going to counter the offer in today's environment, just unless you have a very compelling offer. I've had sellers accept it right away, and I've also accepted offers presented by buyers. But more than often, they're going to counter your offer. A counter to your offer is basically a rejection. So that gives you the ability to just walk away. However, if you really want the house and this is when the negotiating starts, then you come back and you can accept it, or we can come up with a counter to their counter. As I mentioned previously, if there's a multiple offer situation, they're going to typically come back and ask for the best and highest. That is your best and highest offer. That's, what are you really willing to do to get this house? And if you went $1 more and didn't get it, you'd feel okay and you could walk away knowing that, you didn't overpay or you didn't outstretch. You didn't want to, go beyond your budget to be house poor, and you can essentially move on to the next one if you don't get it. So know your limits and make it happen. That's important. Again, in a competitive market, you're not going to be able to get too many deals out there. So again, make it happen if it's something that you really want to move forward with. And if it doesn't work out, stay positive. I've had so many times, including myself personally, when I offered on properties, didn't get it, and then right around the corner we found something that was a better fit for everybody involved. And it's just it can be disheartening. It's a lot of work, but there's always another opportunity right around the corner. So stay positive. And that leads us into step number 5, the last step in the process, which is getting to the settlement table. Our offer's been accepted. The sellers have signed it. We're under contract, gets updated in the MLS. We're going to take our deposit now. Normally, we would take a personal check and deposit that at the office, put it into escrow. Nowadays, we're looking at trying to keep that hands off. So we do have the option to wire the earnest money deposits, to do all that electronically. Also, with a lot of younger home buyers finding that frequently they don't have checkbooks as well. So there are virtual or digital options to deposit money remotely. Then we get into the contingencies. So once we're under contract, it's a timer that starts, and we have certain steps to take along the way. And if we miss those windows, we're either in trouble or we're going to miss an opportunity to get out. The first and biggest is typically the home inspection. Now, the main one that we always do is structural mechanical, unless you're buying the home as is. But structural mechanical is the general home inspection. They're going to go through and look at any safety, any structural, any sanitary, mechanical, just making sure that everything is, well, looking at what's safe and what's not safe, what needs to be repaired or replaced, and they'll put together a whole report for you. Some of these loans require a termite inspection. Relatively speaking, it's fairly inexpensive, and it's worth doing because the seller, if you do find that there are any issues with wood destroying insects, they have to treat or repair up to 2% of the purchase price per the Maryland contract. So that's always good to do for, anywhere from $40 to $80 pretty much for a termite inspection, that they would have to remediate that. Outside of that, you can do as many inspections as you want. Again, when preparing an offer, if I receive an offer and it's like, we're going to do this and this and this and this and this, that's a lot of steps, a lot of things to go through versus somebody who's just doing the structural mechanical. They're doing as is with the right to terminate. So just keep that in mind. But you can do as many as you want. If you're purchasing a property that has well and septic, I always recommend you do that. Any inspection that you do is going to be a cost to you out of pocket, so do keep that in mind. Typical structural mechanical inspection is going to be between $300 and $400. Expect the same for well and septic. So these numbers can add up quickly, and it's stuff out of pocket with no guarantee that you're going to actually purchase the property and you don't get that money back. But well and septic, those things are expensive. If you purchase the home and then a week later you find out, the toilets are backing up, and that's because your drain fields are full, overflowing. The septic tank is bad. You're talking tens of thousands of dollars that you're now stuck with. So, that $400 versus tens of thousands, just to put it in perspective, it's always worth doing that due diligence. Mold, radon, other. In Roanoke County, we don't see too much radon. Typically, that's in the basement. We do have, basically, it's a gas that seeps up into the home that has been known to cause cancer. Typically, around the water area, we have a lot of sand in the soil. We don't see it as much, but again, you can do the radon test, you can do mold, you can do all those. It's just your own cost out of pocket. Talk to your realtor about those different inspections if they're concerns to you, and they can advise you based on what they think you should do. The next big one after you get through inspections, and let me just say that you do inspections. If it's a property inspection notice that we submit, you submit repairs you would like the seller to make. They can say no. They can say we'll make some of them. They can offer you a credit in lieu of repairs as long as it doesn't go above those thresholds that Armin talked about. Or they can accept and say, yes, we'll make all the repairs. That's the best case scenario, and everything moves forward. Anything else opens up negotiations and gives you the opportunity to get out of a contract. So that's why we always include it in there. Appraisal is the next big one. Maybe Armin, if you have anything to add about the appraisal, you can definitely touch on it. But that's when basically the bank is going to say, hey, we're giving you all this money to purchase this property. We want to make sure that the house is actually worth what you're purchasing it for. So the appraiser is going to come in. It's not an inspection. Depending on the loan product, they might be a little more thorough than others, but they're going to look at the property, make sure there's no structural sanitary issues, cracked windows, holes in the roof, things like that. There might be required lender repairs based on the appraisal, but it's not an inspection. But they do want to determine if the home is worth what they're going to loan you the money for. Anything to add on that, Armin?
At Coastline, we do pay for appraisals. And just to kind of piggyback off James, typically VA, FHA deals, they might be subject to repairs. Minor stuff, typically, if there's chipping paint outside or if there's a handrail missing on a set of steps, nothing that's of too concern. Things that are, blatantly that need to be fixed, like if there's a giant hole in the wall, that's going to be a problem, but, that would be taken care of before the appraisal happens.
Got it. All right, yeah. So just so Coastline, like you said, does pay for that appraisal. Typically, the appraisal is going to be around $500. That is something that the buyer is responsible for. You get that report back. It's yours to keep. We don't share it with the seller unless it underappraises, and then we say, hey, guess what? It's not worth what you said it was. And then we get into negotiations about reducing the price. Typically, the buyer is not going to have additional money to pay more than what it appraises for. So typically, we're going to get back into negotiating the price. That's the other big contingency that might, potentially kill a deal. But more usually that $500, it can be sometimes put on a credit card, sometimes paid up front, sometimes put in the settlement costs. And then the last thing is the title work. So this is where you have your lender, where also the buyer gets to choose their title company. And the title company does a lot of the due diligence behind the scenes to make sure that the property is transferred free and clear, removing any types of liens on the home and just getting the deed and the recording. They're also going to be the ones with all the paperwork who conduct the settlement. So when we do have to sign all those papers, they're the ones who prepare that package for you. So Armin, going to let you handle this one as far as closing costs. I can touch on some of this too, but just want to give people an idea, because the closing cost is like this big thing that's always weighing over the buyer as far as what is included in that. We said in Anne Arundel County, typically you're looking at about 3.5%. So here's a screen here if you want to take a screenshot of this. But I know there's a lot of things going on, and it can change deal to deal, the numbers percentage wise, what the taxes are, but this is essentially what's included in those closing costs.
Yeah, so like James was saying, the first section would be down payment. Depending on the loan type, that will determine how much you're putting down. That has to come from the borrower, whether it be a gift or if you use a grant or your own money. The next section is lender fees, then title costs and recording and transfer. All three of those sections can be covered by either a seller credit or a lender credit. All of these items are necessary charges. You're not going to be able to avoid them when you're buying a house, and the 3.5% is going to make up most of these charges. Now, on a conventional deal, if you're only putting down 3%, and let's say James was able to negotiate 3% seller help for you, there might be about 0.5% or so left over that you would have to cover. If you're only available to put down the 3% down payment that you had, then that's when we could look at exploring, raising your rate a little bit and giving you a lender credit to cover the difference. Now, 0.25% in your interest rate might be $30 in your payment, give or take on the loan size and loan type. But that's going to give you the additional funds that you need to cover the difference in closing costs. And in some situations, if you don't have the money, that might be your only option. Or like James was mentioning earlier, if the house underappraised for some reason, and when you're under contract at the purchase price on the contract initially, and then the purchase price had to be lowered 10 to 20 grand, that might affect the total closing cost that the seller is willing to offer. So then we might be in a situation that you might have to explore something like that, or cover it out of your own pocket. Some of the title fees, title company's fees will vary from title company to title company, but pretty much across the board, they're pretty standard. And most of these that James listed will be their title fees. Some of them might label it slightly different, but essentially they are the same fees. HOA dues, if the house has a HOA on it, sometimes a month or so is collected at closing. And obviously if it is collected for the month you're moving in and the month after, you won't have to pay that separately. Let's see what else is on here.
Some of these things are prorated, just to mention that. So, water bills, things like that. If you're settling in the middle of the month, some of these fees are going to be prorated. So HOA dues, if it's, $50 and you're settling in the middle of the month, then you might be getting, you'd be paying half of that, 25 back to the seller if they've already prepaid it. So some of those things are going to be prorated on the settlement sheet. So again, it can never give you an exact amount. If you settle in the beginning of the month versus the end of the month, a lot of these things are going to change. So it's hard to kind of figure that out in the very beginning. What are my closing costs going to be? But we can get pretty close.
Yeah, absolutely. And like we did mention, Coastline does pay for appraisals, regardless of the type of loan that you are getting. So just something to keep in mind if you're worried about paying for the appraisal up front and the chance that the deal doesn't go through. We pay for it regardless. There's no catch to the borrower. Then there's no ties to it at all.
And you do that on refis too, right?
Yes, every type of purchases and refinances as well.
Awesome. All right, so prior to closing, we're getting close. We've gone through all these steps, all our due diligence. We're feeling a little stressed out. We're moving all our stuff, but there's some essential things we need to do as we lead up. First and foremost, ask questions. There's a lot of moving pieces. Most people buy a home on average once every 7 years. If it's your first home, it could be a lot longer than that. You've never done it. So ask questions. It's what we're here for, to guide you, whether it's us or we direct you to a lender or a home inspector or whoever it needs to be. We do this every day, and we're here to answer your questions and help guide you through the process. Next is homeowners insurance. So a lot of buyers are going to first call up whoever they have for their car insurance. That's a good place to start. I have partners who, like Armin, are a broker, and they'll contact multiple companies to get you the best deal. But you will need to obtain homeowners insurance before you purchase the home. Provide that policy to the title company. Other thing is utilities. So that's pretty easy to do. Around here we use BGE most of the time, and you can just go on to BGE's website and set up a start date so that when you take ownership, you continue to have the power and those utilities will be in your name. Loan acceptance. So due to the guidelines that we have to disclose with the closing disclosure or the ALTA at least 3 days prior to settlement. And that's going to break down all those costs and show you exactly what you need to bring to the table and what those other fees were, associated for all those other line items. And then the last thing is initiating the wire transfer for down payment. We typically don't see certified checks or anything anymore. It's all handled through wire. You want to make sure that you're in communication with your title company. They're going to send you instructions on how to send them that money. You call them, you verify. There's a lot of scams going on out there regarding the wires. And so you want to make sure, if you have questions, contact your agent, contact the title company you're working with before you send off that money. But that's the last big step when you're transferring that money over. What do you need for closing? You're going to need your photo ID. I always recommend to bring a checkbook. I don't think I've ever had this happen, but I always recommend bring a checkbook in case there's a little discrepancy. Anything under, I think, like $5,000, maybe it's $2,500, but you can write a personal check to cover that cost. So if there was a mistake, we can just take care of it then and there and not have to worry about redisclosing everything. The notary. So there's a lot of changes going on around the notaries, and just with settlement together with title companies trying to limit. We might have most title companies are still allowing people to come into their office and sign paperwork. We're not really set up yet to do everything remotely, unfortunately, but because of what's going on, we're pushing to get a lot of these changes done. The notaries, remote online notaries is one thing that has somewhat changed, and I'm not 100% sure if it can be done yet, but we can have a notary. Basically, a notary is someone who witnesses you signing and then can stamp the pages so we know that it's you that signed the documents and there wasn't any kind of fraud going on. But we are moving to having the notaries being more remote or mobile. I had a client who took their package to their bank and went through the drive-through window, and the notary was there, and they just exchanged, and we're doing it that way. So people are getting creative with the ways to get this done by limiting exposure as well. So depending on your comfort level and where you are, we can find solutions that are going to fit. And obviously be ready to sign. There's a lot of documents, especially as the buyer. that you're going to have to sign. And typically the title is just going to go through and explain everything and answer your questions that you might have going through it. And then the last step, if this wasn't enough, you get the keys. So whether I pick them up and deliver them to you, or however you feel comfortable with it, if we have the keys at settlement, a lot of times we have the buyer and the seller sign separately, but we'll get you the keys, whether it's in the lockbox. And once you finalize that, the home is yours, and that's it. So just to recap, the 5 steps to home ownership: you want to find your realtor. I always recommend that first. 1 and 2 can be somewhat interchangeable, but you want to find someone you're comfortable with that can make recommendations on who they use, who's going to give you a great experience, works locally, knows the area. And pre-qualified, you want to make sure that you have that document, that pre-approval letter in hand, so that you can include that with your offer and know that the seller can see that and know that you're going to be able to purchase the property. Touring properties, that's the fun part. It's a little weird these days, but we can tour properties. We can do it virtually, or we can do it face-to-face with the proper precautions, making the offer and getting you under contract, and then getting the settlement and getting the keys. So Armin, do you have anything else you want to add before we wrap this up?
If you plan to buy a house in the next 6 months, there's a few things that I suggest to people. Don't change jobs unless you absolutely have to. Don't have your credit pulled for no reason. Don't buy a car, and don't do any large cash deposits. Or, if you're going to move money from one account to another account, I always say consult with the loan officer first, because sometimes it could just cause a bunch of extra paperwork versus just keeping it simple and organized.
Great points. Yeah, there's I haven't had it happen to me, fortunately, yet, but I've heard the horror stories of during the process of the transaction, somebody goes out and they buy a car, or they start buying furniture for the house, and all of a sudden, at the end of it, they go and they check their credit and everything again. I'm like, oh my goodness, like, what did you do? Like, now you don't qualify. That's the situation where the seller's going to get upset and they're going to come after you and take your money because you no longer qualify for the loan and can't purchase the home. So yeah, especially once we get under contract, eliminate those temptations to go out and spend money until it's all done.
Definitely.
Awesome. All right. Well, thank you, Armin, for joining me. Let me jump out. Let me stop the share here. Go back. Let me just check real quick to see if we had any additional questions. Looks like you've been answering some. If anybody has any questions, feel free to leave them in the comments. This is being recorded, so I will go back and make sure that this is available to anyone. If you visit my page, Real Creative Group of Douglas Realty on Facebook, I'll put this on YouTube. We'll definitely make it accessible and answer any questions we get in after the fact. And if that's it, then I want to say thank you, everyone, for watching, and we'll see you again soon. Thank you, Armin, again.
Thank you.